This video is about 12 big mistakes almost all investors make, as said by Warren Buffett. Mistake does not mean the end of the world. Making mistakes is natural. Everybody makes mistakes. It's part of being human. Mistakes help you learn and grow. Think of them like practice runs. You try something, it doesn't work, so you learn what not to do next time. Don't repeat the same mistake. If you keep making the same mistake over and over, it means you're not learning, and that's not good. It's like getting a wrong answer in maths class and never fixing it. You won't pass the test that way. It's okay to mess up as an investor, just make sure you learn from it and don't do the same wrong thing again. Subscribe to my channel and stay till the end of this video to see the big mistakes investors make. 1. Timing the market. Guessing what the entire stock market will do is a bad idea. Warren Buffett, a successful investor, doesn't try to do this. He looks at individual companies instead. Trying to guess the entire market is tempting because things like COVID-19 or other big events can affect all stocks, but Buffett says to focus on what you can know for sure. 2. Getting attached to your purchasing price. Not getting stuck on the price you paid for a stock. Let's look at this example of 3 people, Leo, Ben and Faith, who bought Amazon stock at different times. Leo feels good because he made a little money. Ben feels bad because he lost a lot. And Faith feels great because she gained a lot over 5 years. But the price they paid doesn't matter for what happens next. What matters is how well Amazon, the company, will do in the future. Buffett says to think like you're starting fresh, no matter what you paid before. 3. Aggressive growth projection also means don't dream too big. Another mistake is having too high hopes for how fast a company will grow. Note that very few big companies can keep growing their profits by a lot every year. So if a company says it will grow a lot, be careful. Buffett likes companies that grow, but they do not need a lot of money to do it. If you pay a lot for a stock because you think it will grow a lot, that's risky. 4. Using a lot of leverage. In other words, be careful with borrowed money. The risks of using borrowed money, known as leverage, to invest, it's like playing a game with high risks. Even if you make a smart choice, you could lose all your money. There is a story of a man named Harry who bet against a company called GameStop. He used borrowed money to make the bet. The price of GameStop went up, not down like he thought. Now, Harry owes a lot of money to his broker because he used borrowed money. Harry lost $1.5 million. 5. Missing the forest for the trees. This touch on several key principles in business and investing inspired by the thoughts of Warren Buffett and perhaps Charlie Munger. Important factors in acquisition. It talks about 3 big things you need to look at when acquiring a business: the future economics of the industry, the management of the company, and the price you're paying for it. Keep it simple. Warren Buffett is known for his simple approach. He doesn't get lost in tiny details, but focuses on the big stuff that really matters. Missing the forest for the trees. This is an idiom that means you're so caught up in small details that you miss the big picture. They spend a lot of time on research, maybe too much. Rating system. Use a simple 1 to 5 grading system for different aspects of a company. This helps them quickly see if a company is worth investing in. 6. Jumping over 7-foot bars, like jumping too high. Some businesses are way easier to get than others. We'd rather do simple maths than hard maths. Some people think doing something really hard in investing will make you more money. But that's not true. This mistake is common because it's the opposite of what people think it takes to be successful in other parts of life. Whether it's climbing a hard mountain, jumping really high, or solving tough problems, the idea is often the same. The harder the better. But in investing, that's not how it works. In other parts of life, you get a prize for doing hard things, but investing, that's not true. Doing really tough maths or making hard guesses about what businesses will do in the future often ends up being bad for your money. Just ask the really smart people who worked at long-term capital management. This connects back to the mistake of getting lost in small details. If you find a business that has a good chance to make money, is run by honest and hardworking people, and doesn't cost too much to invest in, you're likely to do well. Simple plans often lead to great money-making results over time. 7. Shrinking your universe of opportunities. In other words, limiting your choices. Keeping an open mind when you're investing. Don't limit yourself to one kind of business or industry. If you do, you might miss out on good chances to make money. It's like fishing. If you keep fishing in the same spot and don't catch anything, you should move to a new spot. Even fund managers know that being open to different opportunities is good, but they might focus on one thing just because it's easier to sell that way. So the main point is, don't limit your options. Be open to different kinds of investments. This gives you a better chance to catch the big fish, or in this case, make good money. Number 8, staying active all the time. We often only listen to what we want to hear. You shouldn't rush when you're investing. You don't have to buy stocks all the time. It's like baseball. A good player doesn't swing at every pitch. They wait for the perfect one to hit. If you try to invest too often, you'll make mistakes. Who is more likely to succeed? Someone who does these things a lot, or someone who does them just a few times a year? In investing, it's better to do less, but make sure it's really good. Sometimes there are many good chances to invest, like in a bear market when prices are low. Other times, like in a bull market when prices are high, good chances are hard to find. The key is to know what you're good at and wait for the right opportunity. So be patient and wait for the fat pitch in investing. 9. Diversifying too much. Don't spread your money too thin when you're investing. It says if you really know about 6 great companies, that's enough. Putting money in more than 6 could be a mistake. If you know a lot about certain businesses, stick with those and you could make good money. If you're not the type to read up on companies a lot, then it's okay to diversify. Maybe buy something like an index fund that spreads out the risk. But if you really know what you're doing, focus on a few strong picks. Adding a weaker investment to your strong ones can make the whole group weaker. 10. Confirmation bias. This means we like to hear things that make us feel right and ignore things that don't. It's like when a door locks after one person comes in and no one else can. This can be bad for investing. You might only pay attention to good news about a company you've invested in and ignore bad news. To fix this, consider these 2 ideas: the darling killing funnel and the bear pill. The first idea, darling killer, is to start with twice as many companies as you plan to invest in. Research them well and then pick the best ones. This way you have to leave out some companies you like, which helps you think more clearly. The second idea, the bear pill, means before you invest in a company, look for reasons it might be a bad idea, or ask a friend to point out problems. This helps you think about both the good and bad, so you make better choices. 11. Following the herd. It means doing what everyone else is doing because you think there's safety in numbers. That's often a mistake in investing. Just because everyone likes something doesn't make it a good investment. For example, if all your friends and family agree with your stock pick, maybe you shouldn't buy it. What most people think is a good idea in investing is often wrong. Like Tesla might be a cool company, but if its stock price is already really high, it's not a good buy. So the main idea is, don't just do what everyone else is doing. Make your own smart choices in investing. Sometimes what works in regular life doesn't work in investing. 12. Omissions. 2 kinds of mistakes in investing: mistakes of commission and mistakes of omission. Commission means doing something wrong, like buying a bad stock. Omission means not doing something you should have, like missing a great stock. Sometimes the biggest mistake is not doing something when you should, like not asking someone on a date or not taking a chance in your job. For example, Warren Buffett missed a big chance to make money because he didn't invest in a company when its stock was low. He was waiting for an even lower price, but it never happened. This mistake cost him billions of dollars. The point is, when you know something is a good chance to make money and you understand it well, don't just stand there. Go for it. Please subscribe to my channel, like my video, and drop a comment.